Managing losses isn't protection, it's participation. That sentence sounds harmless, doesn't it? It sounds like discipline, like wisdom. The kind of thing you'd read in a trading book written by some ex-Wall Street expert who claims to have cracked the secret to survival. You hear it on every podcast, every course, every so-called trading mentor's mouth. Cut your losses early, manage your risk, survive another day. It's repeated so much, it doesn't even sound like advice anymore. It sounds like a commandment, one written by the gods of finance themselves. But what if it wasn't written for your protection at all? What if this entire philosophy of safe trading was engineered to keep you predictable, manageable, and dependent? Let's go back to the beginning. The idea of risk management didn't come from traders. It came from brokers. Back in the early days of margin trading, before everything was automated, brokers had one big problem. Clients would lose everything, sometimes more than they even had, and leave brokers holding the bag. So the brokers introduced something new: risk management policies, stop losses, margin limits, exposure caps, not to save the trader, but to save the broker's balance sheet. But here's where it gets interesting. Over time, that policy got rebranded as a philosophy. It became wisdom. It became the mark of a smart trader. And soon people stopped asking who it really protected. Fast forward to today, 2025. Trading apps, algorithms, influencer courses, all singing the same hymn. Be disciplined, risk small, control emotions. And you feel safe following it. You believe that if you just follow the rules, you'll survive long enough to win. But the game doesn't reward survival. It rewards control. The truth is, safety in trading is an illusion, and the illusion exists because the system needs your fear. Let me tell you a story. There was a man named Richard, a full-time retail trader from Texas, mid-40s, ex-engineer, logical thinker. He had all the tools, charts, algorithms, a clean strategy. He followed every rule of risk management perfectly. No more than 1% risk per trade, every loss cut early, every setup confirmed. But after 3 years, his account was down nearly 30%. Slowly, consistently. Death by 1,000 cuts. He didn't understand it. He wasn't emotional. He wasn't reckless. He was disciplined. But discipline isn't power when your discipline is predictable. He began noticing something strange. Every time he took a position, price would dip right into his stop zone, almost surgically, and then reverse hard in the direction he originally predicted. It was like the market knew exactly where his pain threshold was. And in a way, it did, because the market doesn't just run on charts, it runs on data. Every trade you take, every stop you place, every risk percentage you calculate feeds into massive order flow models run by institutional algorithms. They don't just see your position, they see behavioral clusters. They know, statistically, that 70% of traders will place their stop 1 ATR below the entry candle. They know how retail fear behaves, and so they exploit it. When Richard finally realized this, he stopped trading for a month. He started studying how institutions accumulate positions, and he saw it, clear as daylight. Retail traders were trained to provide liquidity, to lose safely, to be harvested predictably. Because that's what risk management really is, the organized participation of retail traders in a system designed to harvest their emotions. It's not chaos. It's choreography. You can see it in every crash, every rally, every so-called flash event. Look at 2008, the subprime meltdown. While the world was panicking, retail traders were exiting positions in fear. Cut your losses, the book said. Preserve capital, the gurus screamed. Meanwhile, the same institutions that caused the collapse were accumulating assets for cents on the dollar. The risk-managed retail trader was the perfect supplier of liquidity. Then came 2020, the pandemic. Millions of new traders flooded the markets, fueled by apps like Robinhood and eToro. It was the democratization of trading, or so they said. Everyone can play now. But these new traders were trained from day one in risk management. Set your stop loss. Use tight risk. Never overexpose. The result? The entire retail crowd became synchronized, predictable, traceable. During the March 2020 crash, stop after stop after stop got hunted in perfect sequence. The institutions didn't just manipulate price, they orchestrated liquidity collection. Retail traders thought they were saving themselves by managing risk, but they were actually feeding the machine. Let's pause for a second. Think of the word management. Management means control. When you manage risk, who are you really controlling? yourself or the system controlling you through structure. You see, structure gives comfort, and comfort breeds compliance. You've been conditioned to believe that chaos is dangerous, but the market feeds on order, not chaos. Your stop loss, your exposure limit, your risk percentage, these are all points of order in a field that punishes predictability. Here's the part no one wants to hear. The market doesn't move randomly. It moves strategically. Price hunts liquidity. Liquidity exists where stops exist, and stops exist where discipline exists. That's why the disciplined trader often loses more consistently than the reckless one. Because discipline without awareness becomes a pattern, and patterns are the easiest thing to exploit. Think back to 2015, the Swiss franc crash. In a single morning, EUR-CHF dropped thousands of pips, wiping out thousands of retail traders and brokers. Most of those traders had stop losses in place. They thought they were protected. They weren't. Their stops became execution traps during a liquidity vacuum. The same brokers that preached safe trading were the first to vanish when that safety failed. And yet, even after that, the narrative didn't change. The myth survived, because myths that serve power always survive. Let's bring it closer to home. Ever notice how every risk management calculator online, every app, every AI-based trade assistant asks for your stop loss first? That's not coincidence. That's architecture. It's a system designed to categorize your fear threshold. The moment you define your maximum loss, you've defined the boundary of your manipulation. And once your boundaries are mapped, you're easy to manage. That's why trading feels like an emotional treadmill. You cut your losses. You feel responsible. You tell yourself you did the right thing. But the next trade? Same story. It's not a mistake. It's a loop. A perfectly engineered loop of controlled defeat. Let's go deeper into the psychology. Humans are not wired to handle uncertainty. The mind craves control. When something as chaotic as the market confronts us, we build rituals, rules to feel safe. Risk management is one of those rituals. It gives the illusion of control. But illusions are dangerous when they replace reality. It's like a seatbelt on a roller coaster. It makes you feel secure, but you were never driving the ride. In 2020, a behavioral study from MIT analyzed over 10 million retail trades across multiple brokers. The conclusion? 90% of traders who followed strict risk management lost money more consistently than those who adapted their exposure dynamically. Why? Because their decisions were too uniform, too readable. And readability is death in a system that thrives on asymmetric information. Institutions don't need to beat every trader individually. They just need to predict the crowd. And the crowd, thanks to risk management, moves like clockwork. This is why the cut losses early mantra is so profitable. For them, not for you. Because every time you cut early, you transfer liquidity. You close at the worst moment. You provide fuel for the next move. The tragedy is, most traders think they're being professional by doing it. They feel noble, disciplined, mature. They think they've grown as traders. But maturity isn't about control. It's about understanding the game. Let's talk about another event, GameStop, 2021. Retail traders united. It was chaos. The institutions panicked. The rules bent. But the narrative that followed was even more interesting. Within weeks, financial media pivoted back to the same message. Risk management is key. Don't be reckless. Control your exposure. And just like that, the rebellion ended. The system reabsorbed its chaos. Retail traders went back to being predictable, safe, manageable. See the pattern yet? Every time retail breaks free, when unpredictability rises, the narrative of safety returns. It's like a psychological leash wrapped in the language of wisdom. Now imagine you're watching a casino. The dealers, the lighting, the limits, all designed to make you feel like you're in control. But in reality, the entire architecture is built to contain your behavior. The market works exactly the same way. Risk management isn't your escape from danger. It's the fence that keeps you inside. But here's the twist. The system doesn't need to make you lose everything. It just needs to make sure you never win big. You'll survive. You'll last long enough to keep playing. You'll feel smart cutting your losses, proud managing your risk, and you'll never realize you're just maintaining controlled participation. Because losing small, consistently, is still losing. There's a reason why institutional trading floors don't use the same playbook you do. They use drawdowns as tools. They hedge losses with correlated assets. They trade against retail order flow, not with it. They're not punished for being wrong. They're rewarded for managing you. And yet, retail education systems, YouTube mentors, brokers, and platforms all recycle the same template. Discipline equals safety. No one asks, safety for whom? Because when everyone follows the same rule book, the rule book becomes a trap. Now, I'm not saying to be reckless. I'm saying question who benefits from your structure. Question why the system wants you to be disciplined. Question why every retail platform includes stop-loss analytics by default, but never shows you where institutional liquidity lies. Because maybe, just maybe, you're not being protected, you're being programmed. And the ones who see through it, they stop playing safe. They start thinking strategically. They stop asking, how much can I lose? And start asking, who's trying to make me lose? That's where real trading begins, not in safety, but in awareness. So the next time someone tells you risk management will save you, remember this: it's not designed to save you. It's designed to save the system from you. It's not about protection. It's about participation. Because every stop you place, every loss you take, every early exit you justify, fuels the liquidity engine that drives institutional profit. And if you don't break that loop, you're not a trader. You're a participant in your own exploitation. So ask yourself, are you managing risk or being managed by it? Because once you see it, once you realize the safety net was just a leash, you'll trade differently, you'll see differently, and you'll finally understand why the system needs your fear more than your failure. If this opened your eyes, if it made you question the structure you've been told to trust, then you belong here. Because this is Profit Pulse. And here, we don't repeat the market's commandments, we decode its control. Subscribe, and remember, the safest traders never win. The aware ones never lose.